gentlemen, it's time for rock and roll, as we say. Welcome to our fifth event we're organizing here in Mumbai, the fifth year in a row. I think this one is very timely because you had your long-awaited elections, you have your long-awaited Prime Minister, so now it's time, to see if he can really pull it off and, promises the things he will do. For the investing community, it's very important. We are based in Singapore, New York, London, South Africa, everywhere around the world. Everyone is eyeing India. What are they going to do? There's a lot of dry powder, as they say, waiting along the line to be invested into India. But still, a lot of people want to know what's the future, what's the road ahead. So that's why we, as Citco, being the largest administrator in the world, decided to organize another event with this topic. This time we have two sessions. We have a first session of approximately 45 to 50 minutes, where we have three presenters. They have a very strict regime when it comes to time. They will talk and present from the Indian perspective, as well as from a Singapore perspective. So we have two speakers from Nishith Desai, Mr. Joseph Hura and Mr. Sinya, and the second speaker is sitting here, right? And we have Wee Teo, he's a tax partner for Pricewaterhouse Singapore. So they each will give a presentation, whereafter there will be, if people want, a Q&A, but we will have a short coffee break, and then it will be followed by another session, which basically is a panel discussion with 4 or 5 persons, which are relevant fund managers from the industry in private equity and real estate, discussing a variety of topics. This session will be led by my colleague, Vishal Negandhi, our Managing Director of our India office. So, that will be followed by a cocktail reception afterwards. So there will be a reward for sitting, and going through all these conversations. And you get some food and some drinks. So hope, it will be worthwhile. Short thing about Citco, you know who Citco is. For those of you who don't know, we are the largest fund administrator in the world. We administrate 850 billion USD, whether it's hedge funds, private equity, hybrid real estate. We are a leader, but as a leader, we listen to the market. As a leader, we listen to our clients. We need to be adaptive. India is a very important market for the investing community. We see that. We manage a lot of fund managers, and we cater also to the people that invest. And India is very high on their list. So for us, this is very important to hear what the audience and what the specialists, what the speakers can tell us about your economy and the new rules and the promises. Will they come true? Is this investment cycle really going to happen? So hopefully we'll find out. We are committed as an organization, and I hope you too today as well to listen to these presenters. And having said so, I want to give word to the first speaker. I think it's Mr. Joseph Hura from Nishith Desai. Thank you very much.
Thank you very much. So I'll briefly touch upon, the fundraising, because that's something which is gaining momentum with the Modi government, and the international investors starting to get interested in India. As all of us know, the private equity wave in India started somewhere in 2005 when, the biggest deal which made headlines was Warburg Pincus exiting Bharti at a huge valuation. And then suddenly everybody thought that this is the industry to go in because you can multiply your investment, in few years' time. And we started seeing number of private equity funds being raised post 2005. On top of that, the real estate sector also opened up for foreign investment in 2005, and we saw a flurry of funds being raised for real estate. So 2006 to 2009 was, there were multiple funds which got raised, there were multiple investment deals which happened. which a lot of people in hindsight say was a period of blind investing. The funds didn't do proper diligence, a lot of risk was taken. There was no control which any of the funds were exercising over the portfolio companies. They were merely acting as financial investor. A lot of things have changed post 2009 and the world is entirely different. We saw more equity deals happening from 2006 to 2009. What happened because of that was the LPs or the investors sitting outside India who had invested in 2006, they didn't see a single dollar coming back even till 2013-14, which started causing a lot of concern to the international investors that India is a country which absorbs capital but never returns it back. And that's where the challenges started. We started seeing change in the structures from equity to debt structures. Because in debt, at least there is a fixed coupon which keeps on coming to the LPs, and at least that was some comfort with the LPs got from investing in India. So post 2010-11, lot of investments which happened, especially in asset-heavy sectors, were in the form of debt. And I think some of the panelists will talk about debt in the panel discussion. But broadly, the industry has seen a huge shift from equity to debt deals. On top of that, few things which have changed is the LPs were taking a hands-off approach from 2006 to 2009-10, and they realized that it's not a good idea to leave everything to the GP. So the new deals which are happening as far as the fundraising is concerned, we are seeing more and more rights being given to the LPs, or rather being demanded by the LPs, with a lot of control over the GP, which is clearly a shift towards more control by the LPs and reducing confidence on the GPs. In fact, again, going back to 2006-2009 days, the average time to raise a fund by a fund manager was almost 9 months. So the day you start raising your fund, you are able to achieve the initial closing within 9 months. The same period got increased to 18 months from 2010 to 2013, which clearly shows that time is not that great, or rather it was not great to raise an India-focused fund because of the reducing confidence of the international investors. With the new government, there is a lot of hope. In fact, we have been traveling a lot to overseas markets, especially London, New York, Singapore, Hong Kong, which are the key markets for private equity and hedge funds. And there is a lot of interest which has again started as far as the LPs are concerned. Earlier they were not even willing to meet with the GPs. Now at least those meetings are being set up. They're willing to meet with the GPs, understand what's happening or what's changing in India, and they're willing to look at India back again, which is at least a good thing for the industry. Now, let me talk about some of the structuring considerations for the fund industry, especially the private equity funds. Now, when you are structuring a fund, there are three most important things that need to be kept in mind. The first one being the pooling vehicle structure, which is the fund structure. The second is the management structure. So which entity of the group is going to be the manager of the fund. And the third is a carried interest allocation program or structure. So which of the employees or which of the key persons in the management entity or the GP entity are going to get carried interest or performance fee from the divestments from the fund. Now, each of these three categories require special legal and tax considerations. Typically, when you are raising a fund or setting up a fund structure, and again, I'm talking more from an offshore perspective, structuring for a domestic fund is quite simple as compared to an offshore fund. So from an offshore fund perspective, some of the challenges which the investors are facing these days, and post Modi government taking over, there have been number of inquiries on fundraising which are coming up, and a lot of the fund managers are on the road to raise funds from international investors for investing into India. What are the challenges that they are facing right now? The first challenge is, who are your investors? Internationally also, a lot of regulations are changing. So for example, in the US, there is something called a Walker's rule. So if you are targeting US investor and the GP or the sponsor of the fund is a bank, like for example, we are right now setting up an offshore fund for an entity which is an affiliate of a bank in India. Even if the bank has a branch in the US, you get hit by the Walker's rule. And what does the Walker's rule say? The Walker's rule says that as a bank, you cannot invest more than 3% of your own corpus or 3% of the corpus of the fund in the fund. Which means, as a sponsor, even if you want to have skin in the game and you want to invest, let's say 10% of the corpus of the fund, you will not be able to, because you are caught under the Walker's rule, if you are targeting even a single investor from the US. So this is one big concern which a lot of GPs are facing, especially when they are targeting US investors. Second is AIFMD, which is Alternative Investment Fund Management Directive, which is something which the European Union has come out with. What this says is that, as I mentioned, LPs have lost a lot in the past few years because the GPs have not performed. And this is not only the India story, this is across various jurisdictions. So what has happened because of this is, there was a directive that was issued by European Union for protection of the LPs, which means that the LPs are having number of rights when it comes to the GPs marketing the fund to LPs in European Union. And this is just a directive. Each of the jurisdictions within European Union are going to come out with their own local legislation to protect the LPs within their jurisdiction. Now, because of this AIFMD, marketing of funds to European LPs has again become a big pain, because you have to disclose number of things, you have to take number of approvals, you have to manage number of internal efficiencies, you have to disclose a lot of things. So AIFMD is again becoming a big issue for marketing of the funds in the European Union. Similarly, you also have investor specific consideration. Like for example, if you are targeting US investors, typically you will have a tax exempt investor and a taxable investor. So tax exempt investors are all these pension funds, endowment funds, which are the largest investors worldwide. The reason why India is not considered to be a huge LP base is because in India, the insurance companies and provident fund authorities, they are not allowed to invest more than a certain amount in private equity funds. If you look outside India, like for example, one of the largest investors in the US or the LP is Calpers and Calsters. Or you take example of Canadian pension fund, right, which has already committed $1.8 billion in the last 12 months in India. So these pension funds are sitting on huge cash pile, and from their perspective also, the reason why they are investing in India is not only because India is a good market, but they suffer from a huge pension liability gap within their own jurisdiction. And the only way to curb this pension liability gap is to invest in markets which can give decent returns to reduce that gap. And India is one of the markets which, if you are successful in your investment, they would be able to reduce that gap. So that's one thing which is unique in overseas markets, which unfortunately I think Modi government is looking at opening up the insurance and pension fund or the provident fund investments to private equity venture capital fund industry. It might take some time because it's not that easy to do that, but it's something which might happen in the near future. And if that happens, then we will see a huge inflow of funds into fund industry from some of these large LPs. And we can easily make out today, if you see the total investments which have been made in private equity in the portfolio companies, 85% of those investments come from international investors and 15% comes from domestic investors, which clearly signals that there is a need to open up for some of these large LPs to invest in the fund industry. As I mentioned, from a US perspective also, if you have a taxable investor, they prefer to invest through a Delaware limited partnership. If they have tax exempt investor, they use a Cayman exempt corporation. So each investor has its own specific requirement of investment. They will not directly invest in a pooling vehicle. There will be certain local tax considerations which need to be looked at. The next important thing is tax efficient jurisdiction. And we will deal more in detail with, Singapore, Mauritius, Netherlands, and other jurisdictions later on. But broadly, I think it's very important that the jurisdiction has to be such that it should be as if the investor is directly investing from his own jurisdiction in the Indian portfolio company. Whatever is the tax, that much should be the tax, or maybe lesser if I'm using an intermediate jurisdiction. So my intermediate jurisdiction shouldn't add to my tax cost in the entire structure. So that has to be kept in mind. And again, certainty is something that has always been a concern for investors in India. In fact, at one point in time when Vodafone ruling had come out, retrospectively amending the law by 50 years, there was an interesting statement that was made that in India, not only your future, even your past is uncertain. So that's the problem which India has always faced on the certainty. Ease of making distributions. Again, this is a very important aspect in fund structure, because you should be able to distribute 100% of proceeds at one go. Like for example, in India, if you use a corporate structure to set up a fund, and if the fund wants to distribute proceeds to all the investors, fund cannot buy back more than 25% of its share capital in one financial year because of the Indian company law. Similarly, in Singapore, the limit is 10%. Why is Mauritius being used a lot? Is because in Mauritius, you can redeem the shares at one go up to 100% without any restrictions. So the jurisdiction in which you are setting up the pooling vehicle should not only have a good tax law locally, but also have a good corporate law, so that some of these things can happen. Your redemption should be easier. If you want to migrate to a other jurisdiction, depending on the change in the law or change in the tax system, you should be able to flip your company, or you should be able to merge your company with foreign company. For example, in Singapore, there is a restriction, and maybe he can confirm. You can't merge a Singapore company outside Singapore, or you can't merge a non-Singapore company with a Singapore company. So in case you want to do some restructuring within the group, having a Singapore pooling vehicle in the structure could become a bit of a challenge because of the local corporate laws. And again, ability to demonstrate substances with the GAR provisions coming in from 1st April 2015. Again, we don't know in what form they will come, whether the government will tweak it in the next budget. But the way they are currently drafted, it's going to be not that easy to manage the commercial substance test within the what the tax authorities require. These are the regimes which are typically used by foreign investors to invest into India. As you can see, the first one is the regime for overseas portfolio investment. Earlier, there was FII regime. Within FII regime, you had sub-accounts and you had qualified foreign investor. All these regimes were merged into FPI, Foreign Portfolio Investor Regime, from January 7, 2014. Which means that now, through FPI, you can invest in public markets in India. SEBI, which was the authority which used to issue license to FI sub-accounts and QFI. Now the designated depository participants will be able to issue that license under the authority of SEBI. So broadly, if you want to invest in public markets, then you need to have an FPI registration for investing into India. Second is foreign venture capital investor. Now this is a regime which has been there since quite some time. Not many players know about the benefits of this regime, and even though they know the benefits of this regime, not many players have effectively used this regime to invest into India. So, for example, let me explain you the benefits of FACI regime versus FDI. FDI regime is a straightforward regime. You don't need anybody's approval unless it's a government approval sector. You can freely invest in India. So all the strategic M&A deals which happen in India happen under the FDI regime. Now the benefit of FACI regime, there are 3 or 4 major benefits. First one is you as a foreign investor are not restricted by entry and exit pricing restrictions, which as an FDI investor, when you're investing, you have to invest above a certain price, and when you're exiting, you cannot exit below a certain, you cannot exit above a certain price. So that is something which is applicable to FDI. In FACI, you don't need to worry about those restrictions. You can commercially negotiate the price with the seller or the buyer, and you can exit at the price or invest at the price that you want. The other advantage is there is no lock-in post-IPO. So if you are holding shares as an FACI, and if you held the shares for a period of 12 months before the DRHP is filed, then post-IPO there is no lock-in for FACI, which lock-in is there for a period of 1 year with FDI investors. Similarly, if you want to participate in a QIP, qualified institutional placement, FACI is considered as a qualified institutional buyer, and hence it can participate in the QIP, which an FDI investor cannot participate. Now, one of the most important advantage of FACI, which not many people are aware of, is that FDI you are restricted under the put option assured price requirement. So as an FDI investor, you cannot negotiate a put option with the Indian promoter. You cannot negotiate a put option with an Indian promoter with an assured price. So you cannot say that I'll exit at 25% IRR in the next 5 years. As compared to that, in an FACI, there is no such restriction. You can negotiate an assured price return if you are investing under an FACI, under the FACI regime, which is a major advantage as far as the FACI registration is concerned. Now, unfortunately, what has happened is earlier the FACI licenses were blanket licenses. There was no restriction on where you can invest, where you cannot invest, except for the fact there was restriction on non-banking financial services company, which was there under the regulations. But unfortunately, because of some misunderstanding within the government, they started imposing the 9 sector restrictions under the new FACI licenses which were issued post October 2008, which means that only if you invest in these 9 sectors, and those 9 sectors are also like poultry farming, and some of those sectors are there. Apart from 3 or 4 sectors, all sectors are useless. I mean, nobody is going to invest in, no private equity investor is going to invest in those sectors. So infra is one, software development is one of the one, and I think biotechnology is the third one. Apart from that, the sectors are not something which is relevant for the PE industry. So now the only risk is that if you are investing, or if your investment strategy is to invest in sectors which do not fall under those 9 sectors, then your FACI registration may not make too much sense. But otherwise, if you are, let's say you are an infra fund, then it makes a lot of sense to get an FACI license. And the fourth one is the NRI, which may not be too relevant for the audience here, but as an NRI, you can directly invest in the portfolio company. Now, broadly, I will just deal directly with some of the complicated stuff. I think we all know that for setting up offshore fund, what is the structure? For setting up domestic fund, what is the structure? As you can see, let's take an example of a typical GP who is raising both offshore and domestic fund, right? So you are raising an offshore fund from offshore LPs and a domestic fund from domestic LPs. Now, what is the typical structure that you will use? You can see the investment manager in India. Then you can see the domestic fund, which could be set up as an alternative investment fund. Depending on the investment strategy, it could fall within category 1, category 2, or category 3 AIF. And you can see the onshore investors who will sign a contribution agreement for investing in the domestic fund. On the offshore side, you can see the offshore investors investing in offshore fund with the offshore investment manager rendering management services to the offshore fund. Now, one of the biggest questions which comes to the advisors is, what should be the structure? Should it be co-investment structure, which means your domestic fund and offshore fund, they co-invest together in the portfolio company, versus this structure, which is where your offshore fund pulls in money into the domestic fund and your domestic fund invests in the portfolio company directly. Now, let's look at what are the pros and cons of each structure. Now, let's take the co-investment structure. What are the issues? First one is your co-investment structure results in your domestic pool being smaller. So, for example, some of these insurance companies and banks, as I mentioned, they can invest only up to certain percentage of the corpus of the domestic fund. Now, if you see here, let's say you are raising $100 million from offshore fund and you are raising $20 million from domestic fund. The banks and insurance companies can only invest based on the corpus of domestic fund, which is $20 million. So if let's say they are able to invest 10%, then they cannot invest more than $2 million in the domestic fund because the corpus of the domestic fund is $20 million. As compared to that, in this structure, where your offshore fund is pulling in $100 million in domestic fund and the domestic investors are pulling in $20 million, the corpus of domestic fund increases from 20 million to 120 million, in which case they can invest $12 million instead of $2 million in the domestic fund. So for some of the domestic GPs where the LP is from the Indian, LP is from the banks or insurance companies in India, their insistence is always on the unified structure because they want to pull in more money in the domestic fund as compared to co-investment structure where you are reducing the size of the fund. The second challenge is if your entire management team is in India. So let's say you are an Indian GP and you don't have any of the GPs who is residing outside India. How do you address the issue of managing an offshore fund? Because in this structure, who will set up the offshore investment manager if your entire team is in India? For Indian advisor to set up offshore manager, there are challenges under Indian exchange control regulations. So this is one big challenge. If your entire team is in India, the co-investment structure becomes a bit of a challenge because you can't be showing the offshore fund being completely managed from India. Otherwise, you face this issue, which is the third one, which is called permanent establishment. What permanent establishment means is that if your Indian manager is managing the offshore fund, then there is a risk that the offshore fund will be considered to be doing business in India through the investment manager in India. And once that risk is there, then the entire income of the offshore fund could be taxed at 40% in India, which otherwise was exempt as capital gains if it was coming from Mauritius or Singapore. So this is a big risk on how do you manage offshore fund structure when the entire team is in India. Other critical issue is your carried interest structure. Now let's say your entire team is in India. For offshore fund, how do you draw out the carry for the profits made by the offshore fund for portfolio companies in India? So this again becomes a big challenge because under liberalized remittance scheme also, now there are challenges for individuals to set up companies abroad, which are mere holding companies. So you cannot just set up a company abroad which holds carry shares in the offshore fund because under the new FEMA 263 notification, the Reserve Bank of India has said that your offshore company should be an operating company. It cannot be a holding company. So that has again become a challenge on how do you structure carry for the offshore fund. Transfer pricing issues. As you can see in this structure, the investment manager offshore and the investment manager in India, they will typically have an investment advisory agreement. So the investment manager in India acts as a manager to the domestic fund and acts as an advisor to the offshore manager. Now the challenge which is coming up is typically the way the advisory agreements are structured is that you always say there will be non-binding recommendations which will be made by the investment manager in India to the offshore manager. The challenge which comes up is that the markup which the industry was charging was around 15 to 20% to start with. Somehow what the tax authorities have started doing is that they have been equating this investment advisors in India who provide non-binding recommendations with the investment bankers. And in one of the cases, they also charged a markup of almost 69 to 70%, which 15 to 20% is something that should suffice for the work that the Indian advisors are doing for the offshore managers. So this is again becoming a big challenge, the transfer pricing issues for the advisory agreement. And the last one is AOP risk. When you have a co-investment agreement where the offshore fund and domestic fund will be investing in the Indian company in a certain pre-agreed ratio, there is again a risk if the agreements are not drafted properly, that there is an association of persons which is formed between the offshore fund and domestic fund, and the AOP is taxed at the maximum rate applicable to the members, which in this case could go up to 40% because the fund's maximum marginal rate would be 40%. So these are the issues. The benefit of co-investment structure is it's a clean structure. In the sense, the offshore fund is directly investing in India. So in case they are exiting, they can get the treaty benefits directly if they are coming from Mauritius or Singapore. So that's, and you don't have any hassles of going through an Indian entity for investing in an Indian portfolio company. Now, coming to the issues under the unified structure, 2 or 3 main issues. One is FIPB has just started giving approvals for category 2 AIFs, which is the domestic fund. In fact, in last month only they gave approval for unified structure, where offshore fund can invest in a domestic AIF, which earlier they were not too comfortable with. They were okay to give approvals for offshore fund investing in category 1 AIF, but category 2 was something that was kind of a concern for them. Fortunately, last month only they given approval for unified structure for category 2 AIF. Another issue is once you have this unified structure, your domestic fund, FIPB also makes it subject to FDI policy. So even your domestic money which comes from the domestic LPs will be subject to sectoral restrictions. So you will not be able to invest in sectors beyond the sectoral limits which are prescribed by the government, even to the extent of your domestic capital. And the last point is on the tax pass-through for the domestic fund. As all of you might be knowing, July 28, there was a circular which was issued by CBDT on tax pass-through for the domestic funds. Currently, the tax pass-through is available directly only for venture capital funds registered under the VCF regulation and category 1 venture capital funds under AIF regulation. For all other types of funds, they have to rely on section 161 to 164 of Income Tax Act. There is a twist which the CBDT has put in just a couple of months back, where they say that if your beneficiaries are not identifiable, or at the time of creation of the trust, or if their shares are not ascertainable, then the domestic fund will not get a pass-through. Once you don't get a pass-through, your offshore fund's investment will indirectly be taxed in India, and you are not getting the benefit of the treaty. So this has again become a big issue. There are a lot of representations which we are making right now to the government on clarifying the language of the circular, because this is actually killing the domestic fund industry with additional taxes which the domestic fund has to pay. So I think broadly this is what I wanted to talk about on the fund industry and the fund structuring. We'll be happy to take questions later on. I think we are running short of time, so I'll request the next speaker to take over and talk about the Singapore related aspects of the fund industry. Thank you.
Yeah, my name is Wee Hui. I'm a tax partner with PwC Singapore, and I head up the PwC Singapore real estate tax practice, and I focus on fund structuring and international tax. So my clients include listed, unlisted funds, REITs, business trusts, family office, infrastructure funds, real estate developers. And today I'm here to talk about why do we invest into India using a Singapore structure. Right, this is a very brief outline of what I'm going to cover today. There are basically 4 parts. Overview of Singapore tax. This basically, is a discussion about the kind of tax features if you were to invest into Singapore under what I call a non-tax incentivized structure. That means you just use Singapore just like anyone else who invests into Singapore. And then I'll move on to talk about the tax regime for Singapore funds. And so a lot of you may know we do have a tax regime for funds that are set up in Singapore, which you get tax exemption, right? And then we'll move on to talk about fund managers, because if you want to set up a fund in Singapore, you need to have the fund manager in Singapore because you need the substance in Singapore from a treaty and in the perspective. So what does it mean for the fund managers from a tax perspective? And then last but not least, I just want to talk very briefly about the incentives that's used for, that's relevant for debt securities that's raised out of Singapore, because lately we're seeing a lot of Indian real estate infrastructure players that are very keen to raise capital from the Singapore's debt market. So I think it'd be worthwhile just talk about some of the tax incentives that's available in that space. Very quickly, Singapore, we have a very low corporate tax rate, currently at 17%. I think it's very low, at least compared to India, which is about 30%. Not all my clients agree. They still think it's very high. But not to worry, it can be reduced further. That's some good news. So we have lots of incentives, a very comprehensive list of incentives. You can get tax rate as low as 0%. You can get 5, 10, 12, 15. It depends on which area of business you're in and how much financial commitments you're prepared to put into your Singapore business. Now, quasi-territorial basis of taxation, unlike India where income and gains are taxed on a worldwide basis, in Singapore we adopt what we call a territorial basis, but it's only quasi or semi-territorial basis, which means that basically only income and gains that are sourced in Singapore, derived from Singapore, is taxed in Singapore. If you have income or gains that's sourced outside Singapore, it's only subject to Singapore tax if it's remitted to Singapore within the meaning of the Income Tax Act. So Singapore does offer some planning opportunities, for certain, to use as an investment location into certain jurisdictions, but you need to take note of what we call the limitation or benefit clause, because certain income, if you want it to be subject to a lower tax rate under a relevant treaty, you have no choice but to remit it to Singapore. So that strategy of keeping income offshore doesn't always work, but sometimes it works. And in the context of investing to India, it probably doesn't work. Say, for instance, if you're extracting profits from India in the form of interest on NCD, for instance. Now, that interest is ordinarily subject to 20% withholding tax, but the treaty between Singapore and India reduces that to 15%. The problem is, the condition is that for the 15% tax rate to apply, you have to bring the interest to Singapore. The problem with bringing it to Singapore then is, under a non-incentivized situation, there will be incremental Singapore tax. So that may not work so well for funds. For foreign source dividend income, then we have what we call automatic exemption. So there are two main conditions you need to meet. So headline tax rate, at least 15%, and subject to tax conditions, meaning tax must have been paid on the profits or dividends. So if you take an example of a Singapore company investing in India and receiving Indian dividend, then clearly you meet the conditions because India has a higher tax rate than 15%. And second, subject to tax condition is made because there's a dividend distribution tax being paid on the dividend. So basically, in other words, Singapore company receiving Indian dividend, there will be no further tax when the dividend is remitted to Singapore. Another good thing about using Singapore as a holding company is we have no capital gains tax. The challenge is you got to prove that it's capital gain, so it's not always easy. The law doesn't define what capital gain is, so we need to refer to case law. And just like in India, I've read some Indian rulings, they talk about badges of trade and using that to determine what's capital gain. It's the same in Singapore. It follows a UK case law. We have some domestic case law. So, determine whether a gain is capital or business income. We look at badges of trade. Documentary evidence is very important. So you need to have your board papers, your feasibility studies. These are all sorts of documents, even press release. These are all kind of documentation that will be very important to enable you to prove that the gain is capital in nature. But generally, so far based on experience, except in the context of funds tend to be tainted as a trader. So if a fund were to use a Singapore platform and makes gain on disposal, the challenge would be to convince the in revenue that that's capital gain. But it's okay, we have a separate regime for funds which provides a lot of certainty, which I understand from an earlier discussion that's very important. We do have a safe harbor rules that was introduced in 2012 to give certainty on tax treatment. Basically, any gains arising from the sale of ordinary shares, take note, it's ordinary shares, in an investee company for a continuous period of 24 months will be automatically exempt from tax. So this law was, or rather this regulation was introduced about a couple of years back because there were industry feedback to the Singapore government that as a holding location, there isn't much of a certainty when the holding company disposes of shares in the line company. So this rule was introduced to give certainty to that. It's sort of modeled after the participation exemption rules in European, which talks about minimum shareholding requirement and minimum holding period, except that in the case of Singapore, it's a bit restrictive because it only applies to ordinary shares. So, it doesn't apply to gain arising from disposal of other types of equities, such as preference shares. So that, doesn't work as well in the context of a Singapore holding company investing in India, where the equity structure that is being used is more preference shares rather than ordinary shares. But it's still possible because you could always have a Singapore holding company holding shares in the Singapore SPV that holds the Indian investment, and you can always dispose by selling the shares in the Singapore SPV. And if you want to take advantage of this safe harbor rules between the Singapore Holdco and the Singapore SPV, the capital structure, could be in the form of ordinary shares rather than redeemable preference shares. But between the Singapore SPV and the Indian SPV, you can still keep it as preference shares if that makes more sense for investment in India. Now, the next 2 points talks about redemption gains on preference shares and redemption gains on debt securities, because we noticed that a lot of investment in India is in the form of preference shares and debt securities. Now, redemption gains on preference shares are typically regarded as gain from sale of investment because it's not included under the safe harbor rules, which only applies to ordinary shares. You've got to be able to prove that it's capital gain. Again, that can be very challenging in the context of a fund because of the way the inland revenue in Singapore perceive funds. Redemption gains on debt securities, we'll look at this for a number of clients recently. There's no clarity on the Singapore tax treatment, but it's more likely to be taxed as income rather than as capital gains. But if you were to buy and sell debt securities, if you buy gain on sale of debt securities, I think it's possible to argue capital gain if the intention is to hold it long term. Otherwise, if it's treated as trading income, you'll be taxed at 17%. There's no withholding tax on dividend to non-residents, so that's good news. Intercompany dividends between Singapore companies is tax exempt, so dividend is pretty much tax-free. Interest payment to non-resident generally attract a final 15% withholding tax. So if you've used a Singapore platform, one of the issues with Singapore is possibly the return of capital. You need enough retained profits before you can pay dividend. So if you want to use interest as an alternative way of repatriating profits, you got to be mindful of the withholding tax costs. It's 15% in the absence of any treaty. There are some tax planning opportunities that we can look at. You can use treaty platform, for instance, under the Singapore Mauritius and under the new Singapore Lux Double Tax Agreement, and the withholding tax is 0% on interest payment. And there are certain domestic exemption that applies, for instance, on banks-to-bank payments, and there are certain types of debt securities. If it meets certain conditions, the interest payment on the debt securities are also exempt from withholding tax. So there are some planning options you can look at if you're looking at extracting profits out of Singapore in the form of interest. Last but not least, if you set up a Singapore platform and it's all non-resident investors, when they divest the investment in the Singapore platform, good news, they don't have to pay tax because non-resident typically not within the Singapore tax web. So they can buy and sell shares, stocks, units in REITs, business trusts, Singapore companies. There's just no tax. So those earlier three slides basically cover the taxation of a Singapore fund in a non-incentivized situation. And why it's important to cover that, I guess, there are conditions you need to meet in order to qualify for the Singapore incentivized fund. So, it may take some time for you to build up a structure and substance to qualify for those conditions. So I think it's good to also know about, before you get the tax exemption, what could be your tax exposure. Now we moved on then to talk about if you set up a fund in Singapore and you apply for tax exemption. and what are the kind of benefits, what are conditions you need to meet in order to qualify for those benefits. So Singapore has been widely used as platforms for Pan-Asian funds, with Singapore being used for investment in India, Japan, China, Myanmar, Indonesia, and that's mainly because we have signed a lot of double tax agreements, the notable ones being, the rest, those I mentioned. Funds can be set up in Singapore either as a company, a trust, or a limited partnership. So it's quite a lot of legal forms that you can look at. I just want to add that Singapore is in the process of developing a legal framework for what we call an open investment company concept. So once that's ready, and I don't know when, could be end of this year, could be next year, it sort of helps to deal with the cash-up issues of using a normal Singapore company. Because as I mentioned earlier on, if you use a Singapore company to pay dividends, you need sufficient accounting profits. So there could be a situation where you have a lot of cash coming up, but you don't have sufficient accounting profits. So an open investment company basically allows you to distribute cash in excess of your accounting profits, and it could be used as it's open-ended. So you can use that potentially for any listed funds as well. Now, moving to the juicy part, Singapore domiciled funds can apply for tax exemption. We have two very broad schemes for incentivized funds in Singapore. That's what we call the Singapore Resident Fund Scheme, and that's what we call the Enhanced Tier Fund Scheme. The benefits are the same. I'll go through them shortly. The conditions are slightly different. So, if you decide to set up a Singapore fund and you want to apply for exemption, you need to, critically evaluate which incentive suits you better. You need to apply to MAS for these incentives. Approval is entirely at MAS discretion, although we haven't seen the MAS rejecting anyone. It's a tick-the-box exercise, basically. It's a self-assessed thing. There's a list of conditions. If you're satisfied you meet those conditions, of course you need my advice, and if you're satisfied you meet conditions, you can just submit the form online and you get the incentive. It's a rather, the form filling exercise application process is pretty straightforward. Time frames about 6 to 8 weeks upon submission of the application form, so it's pretty fast. The good thing is it's actually more of a formality at the end of the day. Once you submit the application form, on the day that you submit the application form, that will be the effective date of the incentive, so it's pretty good. What are the benefits? Very broadly, tax exemption is not a blanket exemption, so don't think it will be like a Cayman exempt fund. You get 50 years of exemption. You don't pay tax on everything. No. Basically, the exemption applies to qualifying income that's derived from what we call designated investment. So there is a list of what constitute designated investment. It's a very, very long list. So basically, you enjoy exemption on dividend income from both Singapore and offshore companies. If you receive interest income from offshore companies, offshore trusts, it could be a normal loan, it could be some kind of debt securities. The interest income gets exempted from tax as well. Disposal gains from any kind of equities and debt securities, whether it's in the form of sale, redemption, buyback, or whatever, is all exempted under this incentive. So it pretty much, if you think about a fund investing in India, debt security, equities, real estate infrastructure, all kinds of investment structures you can use into India, and however you dispose of it, either by redemption or buyback, it's all covered under the exemption, okay? Another benefit is the ease of obtaining a certificate of residence. I think it's critical from an Indian tax perspective that if you set up a Singapore company, that is respected, that it has its management and control in Singapore. And typically that is evidence if the Inland Revenue endorsed that by giving you what we call a certificate of residence. So in the past, it's pretty easy to get the certificate of residence. It's a form filling exercise. You can even do it online and get it within 3 days, for instance. But these days, the Singapore tax authorities are becoming more stringent. So if you're just an investment holding company, you're foreign owned, you don't have substance, and you're just deriving passive foreign source income like dividend and interest, the Inland Revenue will not give you a certificate of residence. The advantage of then going under this scheme is once you're under this scheme, they will just give you the certificate of residence automatically without any question asked. So if you're in a non-incentivized situation, you could still have substance, but you got to explain it to the Inland Revenue, then they will give you the certificate of residence, but not if you got the exemption. GST remission is important. the current rate in Singapore for GST is 7%, so if you set up a Singapore fund with a Singapore manager and you charge fees, say, let's say you charge 1 million, let's say 10 million management fees to the Singapore fund, that would attract 700,000 of GST. Now, the fund basically is just an investment holding entity. It doesn't really make taxable supplies, which means that it cannot apply for GST registration. If it's not registered for GST, it will not be able to claim back the 700,000 GST that I've talked about. Okay. The benefit of this exemption is that there's a remission scheme, and under the remission scheme, you can claim about 90%, so that kind of helps you to reduce your GST leakages. The fees qualify for concessionary tax rate of 10%. This is more from the fund manager's perspective. If you do enjoy the incentive, which I'll discuss in a little bit detail shortly, if the fee is received from a Singapore company or a Singapore LP or trust, it's taxed at 17% unless the Singapore fund entity enjoys these two exemptions. Then you'll be taxed at 10%. Last but not least, ease of structuring is basically a summary of all the benefits. Basically, it says that if with the exemption, you don't have to worry about Singapore tax. You just have to worry about, what's the best structure for you to invest in India, Japan, China, etc. So that, the last point pretty much sums up, at the end of the day, what does it mean to get this incentive? So that you just focus, get your advice from the Indian law firm on how to resolve the Indian tax issues. Yep. Very quickly, I just want to go through the qualifying conditions. There's some subtle difference between the two incentives in terms of the qualifying conditions. If you're going for the SRF, what we call 13R, the exemption is only granted to a Singapore incorporated company. So if you were to set up a Singapore trust or Singapore limited partnership, that doesn't qualify for section 13R. But 13X is a bit more broad, so whether it's a Singapore company, limited partnership or trust, whether it's foreign, local, you can apply for this incentive. Okay. Under section 13R, it cannot be 100% Singapore owned. So if you think about setting up a fund where the investors are 100% from Singapore, you have to go for 13X. There's no restriction on investor profile for 13X. And even if it's not 100% owned, you need to take note that under 13R, there's a restriction on the amount every Singapore corporate investors can invest in. There's a limitation of 30% or 50%, depending on number of investors you have. So for instance, you're going to set up a fund in Singapore where you have a mixture of Singapore and foreign investors. And if, let's say, you get an in-Singapore insurance company to invest in you, if that insurance company in Singapore were to subscribe 30% or more, then the Singapore company becomes what we call a non-qualifying investor and has to then pay what we call a financial penalty. Now, in that situation, then you wouldn't want to go for 13R because you wouldn't want your investors to be penalized. You go for 13X. But the thing to take note is under 13X, you need to meet a minimum fund size of 50 million. So we have looked at a situation where it's not possible for the fund to start straight away with 50 million. Then it will have to wait for a while before it can apply for the exemption. It needs to be managed or advised by a qualifying fund manager with at least, okay, there's a typo for 13R, is actually 2 investment professionals. For 13X, you at least 3 investment professional. Investment professional basically refers to your portfolio manager, your research analyst, your trader in the case of a security or a hedge fund. And you need to pay them at least $3,500 a month, which is pretty low by Singapore standard. That salary has not changed for the last 10 years, and I don't know why. So the thing to take note is fund management business is a regulated business in Singapore, so you need to be licensed. But there is an exemption that's carved out for real estate investment managers. So, for you guys out there who want to set up a real estate investment management company in Singapore, you don't need to be regulated. You just need to have 2 investment professionals. You want to go for the 13R incentive, and there's no specific requirement on the number of years of experience, these investment professionals need to have, unlike in the case of a regulated entity. These schemes are actually pretty commonly used by family office as well. So family office, if you set up a fund management company in Singapore to manage your family office business, you are also exempt holding a license. And the good thing is, despite the fact that you are exempt from having to be regulated, you can still enjoy the incentives that I talked about. So it's pretty good. Fourth point, very, very important conditions. If you set up a fund in Singapore, you got to use Citco service. That's a very major condition. You got to use a Singapore-based administrator, so that's why you need to speak to Citco. Minimum 200,000 business spending. This is not a coincidence with the business spending requirement under the Singapore-India double tax agreement. It's a separate thing. I don't know how they came out with this figure, but it just so happened to be the same as the treaty. The last point is not really important. So these are the conditions. Not all, but most of them are here. And just for completeness, I should mention that Singapore also has an active listed property fund market. The conditions that, the incentive I talk about is typically relevant only to unlisted funds. Because we have a pretty active REITs and business trust market, I thought just very briefly you should know that, REITs listed in Singapore, they enjoy exemption as well. Okay, the thing to take note is some of these exemption concessions will expire. It's not clear whether those concessions will be extended once the sunset clauses expire. Listed business trusts are treated like companies for Singapore tax purpose, so they're not incentivized if they invest in real estate, but if they do invest in qualifying infrastructure, they enjoy some kind of a tax exemption. So for instance, if you look at Religare is a listed business trust. They invest in infrastructure assets such as hospitals, so they will enjoy some kind of tax exemption. So that's for the funds. Very quickly, I'll move on to the tax regime for fund managers. That's pretty straightforward. So the normal corporate tax rate in Singapore is 17%, but if you do qualify for an incentive called the Financial Sector Incentive Fund Management Scheme, which is administered by the MAS, you get to enjoy a 10% concessionary tax rate. If you're a huge conglomerate with plans for substantial operations in Singapore, because you could have a very diversified business units, that one of which includes fund management operations, you can actually talk to EDB, and potentially you can bring down the tax rate to as low as 5%. In theory, 0, but I think that's very difficult. 5% is probably about as low as you can go. Applications need to be made to MAS for the 10% category. Approval is granted on a case-by-case basis at MAS discretion. The number of qualifying conditions, but basically you need to start with minimum 4 investment professionals with projected headcounts growth. So typically you need to submit like a 3-year plan where you demonstrate that you can grow your headcounts in investment professionals from 4 to about 6 or 7. There's really no hard and fast rule how many. You don't have to double or triple. Usually if you can grow by 2 or 3 within a period of 3 years, they're quite happy. And you need a minimum asset under management of 250 million, right? Time frame to apply for this, 8 to 12 weeks upon submission of the application form. Is a pretty straightforward process as well. Some repetition here, but on the last point, I just want to talk very briefly about the taxation of carried interest. We don't have law that actually talks about how carried interest will be taxed. I suppose that's the case in India as well. It's just that we're not so, the IRAS doesn't really look at this in a great deal. So it's possible for some of the fund managers to actually structure the carried interest in such a way that you don't pay any tax at all, right? I mean, there's some conditions, you need to meet, like you can't be just a pure manager and providing management service. I think if you're putting some of your equity at risk, just like the other LP, then I think there's a case for you to argue that the carried interest is investment return, which if paid out as tax-exempt dividend is actually not taxable in Singapore. This is of course subject to Inland Revenue's agreement, but it is not an area which they actually actively looked at. Generally, it seems like the tax authorities, whether under any kind of pressure from MAS, they don't really audit the fund management industry. Yep, so that's it for fund management. And very briefly, if you're thinking of raising debts, from the Singapore capital markets, there are a number of incentives that you can think about. We have this regime called the qualifying debt securities. So if you have set up a Singapore company and you raise funds from the public, And public means investors in Singapore and investors outside Singapore, because there are a lot of investors from outside Singapore that subscribe to bonds that are listed in Singapore. The good thing about the QDS, the qualifying debt securities, in short, is if you qualify as debt, the interest payment from a Singapore company that issues the bonds to the non-resident, there's 0% withholding tax. If you are Singapore individual, 0% tax. So it's good to migrate to Singapore. We don't tax individuals on a lot of things. If you're a Singapore company, you pay tax at 10%. There are a number of conditions you need to meet, but the basic thing is that the debt security has to be wholly or substantially arranged by qualifying financial institutions in Singapore. Generally, that's not much of an issue. We have what we call QDS Plus, which is an extension of the QDS regime. The main difference is that if you are a Singapore non-individual, you pay 0% tax as well. My last slides, tax exemption of interest income from qualifying project debt securities. This is sort of an extension of QDS, but QPDS applies specifically to infrastructure projects. So, you know, if you have some kind of infrastructure business in India, it could be toll road, wind farms, hospital, whatever, you want to raise debts from the debt capital market in Singapore, you can use what we call this QPDS. You know, again, there's no withholding tax, you know, when you make the payment to non-resident. For all Singapore investors, whether they're individuals or corporate, it's 0% tax. So that's something to think about. With that, I've come to the end of my presentation. Thank you very much. Happy to take questions later on. Yep, thank you.